Perfect. So now let's move to the cash flow statement. So while the profit and loss statement tells us whether a company is profitable, profit alone doesn't tell us how much cash the business actually generated. A company can report high profits but still face cash shortages if customers haven't paid yet or if significant investments haven't been made. That's why cash flow statement is extremely important. It explains how cash moved into and out of business during the financial year. This model uses the indirect method, which is the most commonly approached under accounting standard. Instead of starting with cash received and cash payments, we begin with accounting profit and then adjust it for non-cash items and changes in working capital to arrive at the actual cash generated. So let's start with cash flow from operating activities. That's profit before tax from P&L. So we begin with profit before tax. The value is directly linked from profit and loss statement. As you can see here, directly linked to profit and loss statement. P&L projection C14 means that. If I can show you, C14 is here. Yeah. So this is profit before tax. This is where it's linked to. Okay. So profit before tax represents the company's operating performance before deducting income tax. However, this is still an accounting profit, not actual cash. This formula simply pulls the profit before tax from the P&L statement, ensuring both statements remain fully connected. Moving on to depreciation and amortization. So although depreciation reduces accounting profit, it does not involve any actual cash payment during the year. The cash was already spent when the asset was originally purchased. Therefore, under the indirect method, depreciation is added back. So again, you can see we have the formula that's P&L projection C11. So P&L projection C11 is depreciation and amortization. Perfect. Then comes the finance cost. So interest expenses reduced accounting profit, but under the indirect method, interest paid is shown separately under financing activities. So to avoid counting it twice, we first add it back here and later deduct the actual cash interest payment in the financing section. As you can see, it's P&L projection C13. That's what is C13 here? C13 is finance cost interest. Perfect. I hope you understand how we are getting those numbers here. Okay. So here, as you can see, profit before tax, the numbers in 2028, 2029 have increased. And same with depreciation amortization. But the finance cost has almost remained the same, at least the absolute ones. Okay. So coming on to operating profit before working capital changes. So now we calculate operating profit before working capital changes. At this stage, we have converted accounting profit into operating cash profit before considering changes in receivables, inventory, and payables. So PBT plus depreciation plus finance cost, example C7 plus C8 plus C9, this simply adds together the three values above. Now, okay, this is done. Let's move on to less working capital change. So as revenue grows, the business needs more inventory and more receivables. Although these support future sales, they also lock cash inside the business. That's why increasing working capital is shown as cash outflow. In our forecast, the company invests between 2 and 3 crores every year into working capital. So value comes directly from the working capital assumptions prepared earlier in the model. So less tax paid is next we deduct income tax because taxes represent an actual cash payment made to the government. Although tax expense is already recorded in the profit and loss statement, here we record the actual cash outflow. So P&L projection tax expense, that's what we consider here. Then there is cash flow from operations. Now, finally, we arrive at cash flow from operation activities. This is one of the most important financial metrics because it tells us how much cash the company's core business operation generate before considering investing or financing decisions. Notice that the operating cash flow increases steadily from 21 crores to 28 crores, indicating stronger cash generation as the business grows. Moving on to cash flow from investing activities. So, as you can see, the CapEx, the capital expenditure, this section captures long-term investments made by the company. Here, only inventing cash flow is capital expenditure. Whenever the company purchases new machinery, equipments, or manufacturing assets, cash leaves the business. That's why capital expenditure always appears as a negative cash flow. That's why it's minus 6 crore, minus 8 crore, and minus 7 crore. Formula is assumptions. In assumptions, there's capex. Moving on to cash flow from investing, CFI. So, since capital expenditure is the only investing activity in this model, cash flow from investing is simply equal to negative capex. Now, cash flow from financing activities, this section explains how the company raises money and how it will return the money to lenders and shareholders. The first item is debt change. If the company borrows money, cash increases. If the company repays loan, cash decreases. In this model, the company is gradually repaying debt, so this appear as negative cash flow. Next, we deduct interest paid. Earlier, we added finance cost back while calculating operation cash flow. Now, we deduct the actual cash payment because interest represents financing cash outflow. So P&L projection, interest expense. Finally, we deduct dividend paid. Dividend represents cash distributed to shareholders, although dividends do not affect the profit and loss statement. They reduce the company's cash balance. So this links the profit after tax and P&L with dividend payout ratio defined in the assumption sheet. Perfect. So moving on to cash flow from financing activities. Now this is the total cash movement related to lenders and shareholders. Since the company is repaying debt, paying interest, and distributing dividends, financing cash flow remains negative throughout the forecast. So that change is interest paid and dividend paid. So now we combine all three sections. Operating activities generate cash, investing activities consume cash, and financing activities also consume cash through repayments and dividends. Net result gives us the total change in cash during the year. Now, opening cash and bank. Here it is. So this is simply the cash bank available at beginning of the financial year. For year one, it comes directly from assumption sheet, and for subsequent years, the opening balance equals to previous year's closing cash. So this is the final cash balance available after considering all operating, investing, and financing activities. Notice how cash increases from 18 crores to 36 crores. This indicates that despite investing in new assets, repaying debt, paying taxes, interest, and dividend, the business still generates sufficient cash from operating to strengthen its liquidity. So, one of the most important aspects of this financial model is the closing cash balance. It's not just an ending figure of the cash flow statement, it's automatically linked to the cash and bank balances line in the balance sheet. This creates a complete three-statement financial model where profit and loss statement feeds into the cash flow statement and the cash flow statement updates the balance sheet automatically. Integration ensures that any change made in the assumption flows consistently throughout all three financing statements without any manual intervention. So to summarize the cash flow statement, explain exactly how cash moves through the business. It starts with accounting profit, adjusts for non-cash items and working capital changes, then captures investments in long-term assets and financing decisions such as debt repayments, interest, and dividends. The final closing cash balance follows directly into balance sheet, completing the three statement financing models. Overall, forecast shows a financially healthy business that generates increasing operating cash flows, continues investing in growth, reduces its debt obligations, rewards stakeholders through dividends, and still ends each year with a stronger cash position. This demonstrates both operational efficiency and sound financial management. Perfect. We'll move on to sensitivity analysis in the next video. Thank you so much for watching. I hope you learned something from it.